Hey guys, welcome back to another free training provided by Real Estate School. I am your host, David Dodge, and today I have an amazing guest here today. I have a good friend, a fellow real estate investor, Mr. Jeff Coffman. Jeff.
House so easy, we close fast, and anytime that works for you. Your house don't need it, we'll throw cash at it so fast, don't know what to do. Wanted to care to keep it, no.
Hey guys, welcome back to another free training provided by Real Estate School. I am your host, David Dodge, and today I have an amazing guest here today. I have a good friend, a fellow real estate investor, Mr. Jeff Coffman. Jeff has agreed to come and help provide value to our awesome growing community here today. Jeff is an expert when it comes to creative financing, specifically subject to, I've known Jeff for probably 7 years at this point. And anytime I have a question, a concern, or even just look to get some advice about a deal, when creative financing and subject to is, on the table, Jeff's the guy that I call. He's my guy, right? He's the go-to guy in my sphere. And I just figured, you know what? Instead of me trying to teach this particular topic, I'm going to bring in somebody who knows even more about it. So, guys, welcome. Stick around till the end. There'll be a Q&A. This replay will be archived in the Skool replay library forever as well. So I'm glad that we have some individuals on this free training. But again, there'll be a replay as well. So without further ado, Jeff Coffman, welcome. Thank you for being here. Good morning. How are you, my friend?
I'm doing well, sir. Doing great.
Awesome.
Up bright and early this morning, making sure I had all my ducks in a row. I'm ready to rock and roll.
Well, Jeff, I can't thank you enough. Really, really appreciate it. We're going to have to go grab some dinner, definitely sometime soon. But again, today's topic is specifically subject to. So I just really wanted to, and I know you're going to have some slides and some stuff, but I really just, the goal here, and I mentioned it before we hit the record button here, but we have a lot of new individuals in the group, right? There's definitely some people like me and you that have tons of experience. We have a lot of new individuals in the group. So the goal for today's training is really just to kind of, make it very simple, right? Nobody wants complicated. Let's try to focus on making this really, really simple. So maybe in the beginning or right out the gate, we just talk about what it is, how it works, and then we maybe walk through a deal and just kind of show what the steps are. So anybody that's new can essentially add this tool to their belt. That's the ultimate goal. How can you watch this video and then leave it and have this new tool in your belt? Because that's what Real Estate School is all about. It's providing that tool belt for all these investors and newbies and individuals so they can hit ground running and get out there and start making money just like me and you do on all these deals, Jeff.
That's right. Yeah. And honing in on this particular subject, and this is something that I've been doing now. In fact, I got into real estate. That's how I got into real estate. When I started this whole thing, I think you and I met.
It was 7 years ago at a Mexican
maybe even
restaurant
8,
or something like that. Hey, maybe even 8. Yeah.
But actually, I tell people this story a lot. I talk about you, how you kind of, I saw what you were doing out there. Like I saw you in the Facebook groups and everything. Mm-hmm. And I was like, man, this guy is rocking it. And that's what kind of got me veered off into wholesaling, which I don't particularly care for wholesaling. It's not my thing. I know myself well enough that it's like wholesaling is not for me. I'm not that high speed. You are like pure energy. And I'm just like, man, I got to chill for a minute, but not you. So yeah, when I first got started, for maybe like a lot of people that might be on this call, I didn't have any money, man. I had an 813 credit score.
That's good.
I couldn't, it's fantastic. I mean,
that's good.
I haven't had it since I started this business, by the way. But no, I mean, I had this awesome credit score, but I had no money. I had no money to go out and put this 20% down and all of this stuff. I didn't have any kind of, if you're new, you don't have this pool of private lenders that you can go out and rely on and solicit for cash when you need it. So, the very first deal I did, I just went out, I kind of jumped off the cliff and I was like, how in the hell am I going to pay for this? How am I going to do this? But I went out and had this property under contract. And ultimately what I ended up doing was I ended up taking over the mortgage of this woman's property. And if we've got a second, I'd like to tell you that story real quick. And
tell us.
Yeah, this is kind of so a little bit on the marketing side. I come from a tech background. And so I knew, and I had a job at the time, so I knew that I wouldn't be able to dedicate a bunch of time to marketing. So I chose Google pay-per-click. That's what I was doing. I chose AdWords, or it's ads now, but I chose AdWords.
Mm-hmm.
And so I spent a good, I don't know, month and a half building out this massive Google Ads campaign. And I was always terrified to click go, though. I was always I would get it built and I'd be like right there, like my mouse would be right on the button. I'd be like, oh no, this is going to be too expensive. It's going to be way too expensive. So finally one night I had as the story goes, I had a little bit of liquid encouragement, and I said, screw it. And I pressed the button, I pressed go. That was on Saturday night. I go out the next morning, I get up, I'm out cleaning out my garage, and I have my phone on my hip, and my phone goes off, it dings. And I look, and it's a new lead off of the ads that I just set live the night before. So that lead cost me $6. Keep that in mind. All right, that was a $6
lead, man.
It was back in the early days of pay-per-click. Yeah,
man. I'd love to get some $6 leads.
Yeah, no kidding. So make a long story short, I went out that evening, and I had my very first house under contract. And kind of condensed things a little bit more. 30 days later, well, actually it was 45 days later, I found out a little bit of something called about something called title seasoning, which I had no clue about anyway. So anyway, 45 days later, I walked away with a check at that closing for $41,000. And really, this is kind of the situation with that one. And this is probably, when you say we're going to talk about a deal, I like to talk about this one because this one really, really hit me hard. The lady, she was diagnosed with a terminal illness, a terminal tumor, right, in her brain. So she goes out, she blows all of her money. She goes on vacation. She goes to Australia. She, she stopped making payments on her house. She stopped making payments on her cars, everything. Took all of her money out of savings. She's just, and I think I would probably do the same thing. I don't know about you, but
I probably would do the same thing, man.
Yeah. Well, come to find out, she was misdiagnosed. And so terrible situation.
I mean, you know what though? Like, that's best case in a way though. Like, so what? We could all make more money.
Yeah.
Like, you get another chance at life. Like, it sucks. It's sad. But like, if I was in her shoes, I would be jumping with joy.
Yeah.
I mean, think about this, right?
Yeah. She, I agree with you, but she was definitely in a bind at this point.
And yeah, absolutely. Short term.
Yeah.
Sure.
We were both kind of in a bind because I didn't have the money to pay for this house. And quite honestly, she didn't have a ton of equity in this thing. At least that's what we thought. So anyway, we ended up buying that house subject to, where I just took over the mortgage. I actually helped her. We found her a rental property up in Overland. We got her moved out to Overland, and I picked the house picked it up subject to, turned right around and put it on the MLS. It was kind of like a wholesale deal. And like I said, walked away with a check for $41,000. I was probably in it for about $8,000. So, I'm in the low 30s.
So let me ask you this. The 8, was that catching up mortgage or just paying mortgage? Was it rehab? Where did that 8 go?
So she was 6 months behind on her mortgage. So I think this is a while back. So the motivation was there for her because she was going to lose this home anyway if she didn't do something. Yeah, she got her auction notice. That's another thing too. With these types of deals, with the pre-foreclosure deals, you got to work fast. I mean, you got to be. I've seen, if you're in a non-judicial state like we are, you have to work super fast, because I've seen properties go from 120 days delinquent to the actual auction table in 21 days. So by the time the auction date is set to when it's actually sold at auction, 21 days. That is nothing. So you got to work quick, and this was really the perfect situation, because I was able to work quick. I was actually sitting down at Millsap and Singer in their down in their Chesterfield office with a check which I had to get creative on as well, because that check, I told you I didn't have any cash, but she was, I forgot how many thousands behind. So what I did was those little, told you I had good credit. So I went out and got a credit card, and they send you those checks.
Yeah.
So I send you the checks to transfer balances. I went and wrote myself a check, and that's how I paid the arrears on that property. So I literally had nothing into this property, nothing at all. I gave her $20 as earnest money.
So you use leverage in so many different ways. You use leverage to take over the existing loan. So you didn't even have to, you bought the property, but you didn't have to finance the purchase.
Correct.
And then you had holding costs, which essentially you had, in order to buy it, you had to catch her up. And then you probably made 1 or 2 payments, I'm guessing, while it was listed in the process of being sold. Maybe only one, but a couple. Yeah. But you leveraged your credit to get the rest of the money. Correct. How beautiful is that, right? And then you made $41,000 on this deal.
I don't know what actual profit was, but yeah, that's what I walked away with.
Walked away with 40. So let's say that you had to pay yourself back to 8. You made $33,000 in profit on a deal that you didn't necessarily have any money, out of pocket. You did in a way, but it was leveraged. You borrowed it, you paid it back, right? So, and it was probably maybe 6 or 8 weeks, this whole thing, or less.
Yeah, it was. I held on to a little bit longer than that, but essentially it was a very short period of time. I had to wait for this title seasoning to happen, because my buyers were going to be FHA buyers, and so you have a 90-day holding period, which that's now changed. But anyway, yeah. So yeah, that's what is possible with a strategy like that. So this is what's possible with Subject 2. And I'll tell you, I did that deal. And then while that deal is getting ready to close, I picked up another one exactly the same way. I actually moved that seller to Florida, and I took over her house while this was going on. That was another $25,000. And then I had another. So essentially my first 3 deals, the first 3 deals I did was Subject 2. And then that's when I found David Dodge and saw what David Dodge was doing. And I got sidetracked. I got squirrely, and I started looking into wholesaling.
So you're back though. You're back here now.
Yeah, for me, it just wasn't right for me. It was like I said, I'm kind of a lower speed guy, and with wholesaling, you got to be on it.
That's right.
Almost all the time. So why don't we do this? Why don't I share my screen, if you don't mind?
Yeah, please.
I've got a presentation here that I've used before. Okay, so I'm just going to roll through this thing. like I said, I've used this one before. I don't know. It doesn't get too detailed. I know we want to kind of stick to the subject at hand here. So there's gonna be a couple of things that I'm gonna bounce around on here, but
it's okay.
It's gonna give you some ideas.
Really quick, I saw Nick had his hand up real quick. Nick, what'd you have, man? Before we jump on in.
Yeah, I wanted to know if Jeff had his real estate license on those first 2, because I heard he said he put on the MLS to sell a property.
Oh, good question. Did you hire an agent, Jeff, or did you do that?
So at the time, I don't do this anymore. To answer your first question, no, I do not have a license. In fact, I had my wife get licensed. I didn't really want to be licensed. So I do not have my license. And at that time, to my knowledge, the only way to get properties on the MLS was through an agent. I quickly learned that can be a little bit expensive. And personally, today, my personal feeling on it is a listing. I think listing agents are probably going to go away, and I've been saying that for a few years now, but I just don't see a reason to list a property with a listing agent anymore. I use flat fee listing services now. It's the same MLS. It's the same data. except I spend
Yeah.
$169 versus several thousand. So
That's awesome. Flat fee listings. And you're still paying the buyer's agents or no?
I am, and I pay the buyer's agents the full. I don't nickel and dime them. I give them the full 3%. I need that traffic coming through my properties, so I'm happy to pay them. Yeah,
but the listing side's less than $200 versus 3%, which, as we know, could be a big number or a huge number.
Absolutely.
So cool. Good question, Nick. Thank you for answering.
Thank you,
Jeff.
Thanks, Jeff. Appreciate it.
No worries. I'm going to spare you the gory details about me, but I'll just I told you how I got into it. Really, I started out with creative financing, although I did not know that's what it was called. I was just looking for a way to actually pay for these properties. But there's a couple of reasons that I really, really love the creative financing side, and particularly subject to. And when we talk about subject to is just one of the many, many strategies that we have available to us. It's a financing strategy that falls under the creative financing kind of umbrella. There's many, just tons and tons of ways you can get creative with financing, but subject to happens to be my favorite. And if anybody wants to take a guess, what my number one, the number one benefit to buying subject to is, you're welcome to jump in here.
Low interest rate.
100%. Yep. I think the low interest rate is fantastic, but that's probably the number two reason for me. My number one reason is because I do not have to qualify. And I'm going to get into
there's so many good reasons. You don't have to qualify. You can get better rates. You can get farther into an amortization table. You know, one of my favorite strategies with subject to creative finance, seller finance, whatever you want to call it, because it's all similar in a way, right? But is not having to buy the home to fix it up and sell it. You know, so it doesn't even have to be a long-term play. Jeff, I didn't mean to interrupt. I love this topic, and I'm super excited that we're doing this. So just, thank you.
Yeah, for sure. But so the lower interest rates is obviously a really good reason, but I like not having to qualify. And I'll explain a little bit about why that excites me so much in a little bit later slide. Because it's a very important thing. It helps me with a mindset issue that I've had when it comes to real estate. So okay, so here's what we're going to talk about. We're going to talk about so first of all, let's make sure that everybody's on the same page here. Everybody understands what it means to buy a property subject to the existing financing. And it's exactly what it sounds like. Financing stays in place. You're going to go out and you get a property under contract. You are going to elect to close on it. We're just going to keep it at that. We're going to keep it simple. You're going to elect to close on it, but you're going to do it with the financing that is already in place on that property. So that is what a subject to purchase is. There are some other details, obviously, but to keep it really simple, that's what we're talking about here.
So when you buy the property, the deed transfers. So let's say Jeff has a house that he's selling to David. We're going to go to the title company, and the deed's going to transfer out of Jeff's name into David's name. But what's not going to happen is I'm not going to have to go to Bank of America or Chase or US Bank or Wells Fargo or whatever bank you use. Those are obviously some big ones everybody's familiar with, and get approved for a loan, go through all the underwriting process and all the applications and all the nonsense, right? I'm just going to essentially say, Jeff, I'm going to keep your loan in place and just take over the payments on it. But you're going to sell the property to me. So it's going to be out of Jeff's name on the deed, but the loan's still going to be in his name, and I'm just going to take it over. Right, Jeff? Am I saying that right?
You got it. 100%. Yep. Okay, so understanding that, here's what we're going to talk about. We're going to talk about a couple legal issues with subject to purchases. Talk about the some of the benefits and downfalls of buying properties subject to. This third bullet point is probably the most commonly misconstrued and asked question when it relates to subject to real estate. All right. And that is the due on sale clause. So we're going to talk in depth about the due on sale clause. And all the due on sale clause is if I do sell my property subject to David, there is in that mortgage, or in that recorded deed of trust and or mortgage, depending on which state you're in, there is going to be a provision in there that allows the banks to accelerate your mortgage if you transfer the deed to somebody while not simultaneously paying off that loan. So that is what the due on sale clause is. It allows the lenders to call that note due, accelerate that mortgage, and ultimately you have 30 to 45 days to pay that off. There's some leeway there, but that's what.
So just because they can doesn't mean that they will.
Right.
It's possible, but
Yep.
from my experience, it's pretty rare. Jeff, has this ever happened to you?
It's never happened to me. And I've only known 2 people. Now it does happen. I'm not going to say that it doesn't happen. I've only known 2 people that this has happened to. And then after, upon further investigation and further digging into why this happened, as it turns out, number one, there was an insurance issue. So you got to make sure that insurance is set up correctly. And this kind of tipped the bank off. And the second one was the other guy wasn't making the mortgage payments. So
yeah.
I
So
mean,
from my experience,
Yeah.
anytime I've heard of it, and just like you, it's only been 1 or 2 people that I've ever heard of in 10 years time. Every time of the 1 or let's call it 2, just use a quick simple number here. All 2 times that I've heard of this happening, the payments weren't being made.
Yeah. 100%.
So if you keep the bank's not interested in taking properties. Last I checked, banks don't rent properties to people. They lend money and they collect interest. And if the interest is being collected, they don't really care. If the interest isn't being collected and the loan's not being paid, well, then they're going to care. It doesn't matter if they sold it to you subject to or not. They're going to go get that property back.
Right.
But again, from experience, they're not interested in getting in the way and causing problems. They want their payment. That's all they typically care about.
That is very true. Very true. And we can get into why the due on sale clause was ever even in existence and all that stuff, but we'll save that for if somebody really wants to know at the end.
Yeah, for sure.
Next bullet point, we're going to talk about some numbers behind subject to deals and when it makes sense to buy subject to, and when it makes sense to pass on a deal.
Sweet.
We may get into this. This is going to be one of those kind of touchy areas, the entity structure for subject to deals. It is important. We're going to definitely cover some of the strategies, but this can get really, really complicated. And so I don't want to, get people off track and worrying about something that is going to come later on down the road anyway. So then we're going to talk about how to properly insure a subject to deal. It's one of the, I only put that in here because it's one of the big questions. It's probably the second most asked question behind the due on sale clause is, well, how do you structure the insurance on that? And then we'll have, if we have
touch on that for sure.
Yeah. If we have a little bonus time, we'll talk about liens in general, because when we say we buy subject to existing financing, that's not necessarily all that we are willing to buy on or to buy into. Okay. We love liens. We chase after liens. Liens are our friend, and believe it or not. So yeah, that's what we're going to go through here. Let's go ahead and jump in and get started here. All right, so we already kind of talked about this. Let me move this thing over here. I got you guys on the other screen. So good. Subject to a financing strategy for acquiring real estate whereby the buyer assumes the debt that a seller has secured through a loan without actually assuming or even qualifying for the loan. The buyer simply takes over the responsibility of making the payments from the seller in exchange for legal title to the property and or other consideration. One thing that I want to point out here, and I want to make 100% clear through this explanation that I just gave you, is that you got to understand that we are not going out and qualifying for loans. We are not assuming
which
loans.
would be the definition of assuming, right? Assuming
Correct.
would essentially be, because I've done this a couple times actually with sellers where they have a loan and it's a good loan and they have a good rate, and I don't necessarily want to go get a higher rate. So I'll actually contact the bank, and I don't recommend doing this. I recommend doing what Jeff's teaching, honestly. But I do have experience with assuming a loan. So I'll contact the bank and I say, hey, I want to assume this loan. Some loans are assumable, some aren't. And then they're going to say, all right, David, you need to apply just like any other person would. And they're going to send me an application, and they're going to want my taxes, and they're going to want my this and that. And they're either going to say, hey, you qualify or you don't. And if you qualify, you essentially just take over, and that person is off of the transaction. Whereas a subject to, they stay on. So I'm glad that you mentioned that, because before we finished that first sentence, I'm like, wait, what? But then you said without actually assuming it. I love it.
The key words here that I want you to focus on in this explanation is we assume debt. We do not assume a loan. We assume debt. We promise to pay debt. And so that is a very important distinction because, if the fact of the matter is, if you stop making payments on that loan, it doesn't affect your credit at all. It's going to affect your sellers for sure. So we make a promise to pay the debt. That's what we do. We don't make a promise that we're going to assume the loan. We're going to assume the debt. All right.
Awesome.
All right. When we talk about legalities, you have to understand, I think, that subject to, no matter what anybody tells you, I don't care who it is, subject to is not a legal matter. It is legal in all 50 states. You can do this anywhere in the country. There's some places you probably don't want to do this in, but I don't know. I guess maybe that's a little not even political. It's just more there's states that are not friendly for landlords.
Yeah,
so
some areas might be a little bit more challenging, but it's not like you're ever going to get arrested. Let's put it that way.
Correct.
It's legal in the sense that there's no repercussions. Criminally at a minimum, right?
And if you want to look that up, all you have to do is go out to just Google HUD-1 settlement statement. You will find on a HUD-1 settlement statement, lines 203 and lines 503, you will see that that Fannie Mae and the Housing and Urban Development, Department of Housing and Urban Development, that's hard for me to say.
Same.
Yeah.
I always forget it too.
But if you look at that HUD-1 settlement statement, you'll see that there are lines for taking properties subject to, and that's exactly what they're there for. So this is legal in all 50 states.
So the government baked it into the settlement statements that all title companies and closing attorneys use on this, though they use those basically standardized forms. And on those forms, there is lines for this.
100%.
Amazing.
Yeah, they're even on now we use ALTA statements. Most title companies use American Land Trust Association. So it's all baked into the ALTA statements as well. This is how you know whether or not you're dealing with a good title company or an investor-friendly title company, because if they don't know what that line means, then you probably need to look elsewhere for a different company.
Good call.
So yeah, legal in all 50 states. You will find provisions for when we talked about the due on sale clause. You will find that provision in almost 99.9% of all deeds of trust or recorded mortgage. But it's a policy feature. It is not a legality issue, right? It's a policy for all the lenders, and it's just pretty much baked into every single mortgage that you're going to find out there. All right. So I want to make a really important distinction here. And this is my own personal, don't laugh at me about this. Don't judge me. But this is actually how I feel about taking a property subject to.
Yeah.
So my definitions: earning enough of the seller's trust that the seller is willing to deed a property of which they have an enormous personal stake in to me in exchange for the promise of managing that gift in a reliable, trustworthy, and diligent manner.
I love that definition, because
it has to be that way, though.
It has to be that way, because this is so, you have to build trust with the seller, and they are trusting you to make those payments on their behalf. You could easily, right, proceed with a subject to transaction, and I don't recommend you to do this by any means. Come on, have integrity, guys. You know that I have a ton of integrity. I'm constantly preaching, if you can't make this work, don't do it. Don't do it, right? but they are trusting you, because if you buy a transaction subject to and make no payments or 1 or 2 payments and stop making payments, you are going to destroy their credit. That is not a good thing. Do not do that. I am not promoting that. I know Jeff would never promote that. You have to have trust. Boom, there it is.
Yeah. So I'll give you a real quick little story about why this is so important to me. And it's because it's a pain point. Back when I got started, and I think this was my, I don't know, 3rd or 4th subject to deal. I had to sell. Oh, it was the one that I moved to Florida. Actually, it was the one I moved to Florida. I was going to flip that deal. I was going to flip it. So I already had a buyer lined up. Me, being, I wasn't really low on funds at this particular time, but I was like, you know what, my buyer's coming in, my buyer's going to buy it. I'll just let them pay off, and they were going to pay off the whole mortgage and everything. I just closed on it subject to. I was flipping it.
You were getting control.
Correct. So it was supposed to close on, I think it was a Thursday, which happened to be the 15th of the month. So what do we have a grace period, right? And most mortgages between the 1st and the 15th. I was like, well, cool. This is going to be paid off on the 15th. Well, my buyer backs out at the closing table. He backed out. So I was literally a day late making that mortgage payment. And do you know that woman still haunts me to this day? She has been a pain in the ass because of that late mortgage payment. And I don't blame her. I really don't. But that's what happened to me. Well, that's what I did to me. Is I
now that didn't affect her credit, because it has to be 30+ days for it to affect your credit typically. But regardless, you and her had an agreement. You were 1 day late on it. You knew you were in the wrong. Yep. And she still lets you know about it, it sounds like. So again, absolutely. The point here, folks, is if you say you're gonna do something, do it, right? Because you don't typically have a repercussion, they do. And that's part of you getting the deal and you know, I don't really want to use the word selling, but you selling yourself, building trust, you know, is going to be telling them, hey, you know, I'm going to make sure that these payments get made, because if they don't, it doesn't affect my credit, it affects yours. Right. So you want to definitely try to build that trust up with them. And then, of course, try to, you know, do what you say. Don't try. Do what you say. Jeff, thank you for sharing that.
Yeah. Yeah. No problem. I mean, you're 100% correct, because I mean, this woman was her credit was already damaged. I mean, when I met her, she was, honestly, she was struggling to feed herself. So it was like, but it didn't matter. That's not the point. The point is I made a promise to her and I didn't keep my promise. And so that's why this is so important to me. And since that happened, I've never even come close to missing a mortgage payment.
Nice.
So understand that
you didn't miss it. You just were 1 day late. Let's be real.
Well, yeah. So you're making a promise your seller, you should regard as an honor. That's the way I look at it. They've gone out, they've done the work, they've qualified for this mortgage. They're handing it to you, right? They're trusting you. So so make your mortgage payments. If you know, if you suspect, if you have an inkling of a suspicion that you cannot afford to make that payment right out of the gates, do not do the deal. That's just that's my rule on it. So, all right.
I love it. Here, really quick, Tammy has a question. So the seller no longer owns the home, but the mortgage stays in their name. Yes, Tammy, that is correct. And that's where the agreement. No, don't be. I want you to ask questions. So thank you for asking. That is correct. So Jeff's going to explain, you know, in the next couple of slides how that's actually going to work. But the mortgage stays in their name, but you become the owner of it. So you have the obligation to make those payments until you refinance it or sell it or pay it off. Those are essentially the 3 things that can happen. The 4th thing would be you don't, and then it gets foreclosed on and their credit gets destroyed. And then they're going to be very upset with you. So obviously try to avoid that 4th thing, right? You know, make those payments until maturity, make those payments until you refinance it, or make those payments until you sell it off to a third party person. Yes, ma'am.
Thanks.
Of course.
All right. Good to go. All right, here we go. Some of the benefits. We've already talked about this a little bit. No bank qualifying. I've already shown you it is 100% possible to buy real estate with or no money at all. The second deal I ever did was kind of the story is we were heading out to Mexican. Dave, you know, on Friday nights, me and my wife go to Mexican. That's just our thing.
Yeah.
So we're heading out to Mexican. I get a call from this guy, and I pick up the phone, and he goes, "Hey," he goes, "Do you buy houses?" I was like, well, "Sure. I mean, yeah. What do you got?" He goes, "Well, I just signed a 30-year lease with this guy, and I'm really not sure I want to do that." And I was like, "Well, why did you sign it?" So he signed a 30-year master lease with this guy. So ultimately, I went over and put the property on. I called the guy. Basically gave the guy that he signed the lease with. I gave him $500 to disappear, and I signed that property up. And I didn't give this guy earnest money or anything. He literally handed me a check for $25,000. Is what he did. Effectively, that's what he did. Mm-hmm. So, and there wasn't a ton of equity in that deal. I think that was all that you could squeeze out of that deal, but he handed it to me. I had nothing in the deal, nothing. I didn't paint that house. I didn't do anything to that house. Just put it right back on the MLS and shipped it through.
And when you say he handed you a check, he handed you the value.
He handed me keys.
Hypothetically handed you keys. Well,
Right.
He handed you the keys. That's real. But
Right.
He hypothetically handed you a check that you got later when you sold, right? So he was like, here's the keys, but within these keys, there's a house, and that house has equity. So Jeff bought that property subject to the existing financing. It wasn't paid off when he bought it. He owed money. Now, he may have sold it before he even had to make a damn payment. Maybe he did, maybe he didn't. But regardless, he then sold that property at a later time. Could have been 3 days later, could have been 3 years later. It doesn't matter, right? And when he did, he got $25,000 above what was owed to the mortgage.
Yep.
Simple. Don't overcomplicate it, folks.
Yep.
This doesn't have to be complicated. And Jeff does a great job of keeping it simple. So again, thanks for being here, Jeff.
Yeah. One of the glaring items to me that may not be so apparent to a lot of people is that I get to buy houses that so many other investors would just simply pass on. You know, particularly, and you know, I pick on wholesalers because I used to be a wholesaler. Mm-hmm. But you know, wholesalers, you know, you've got to have this built-in. You got to have this equity. You have to.
You got to be able to sell it. Let's back it up just for a quick second. You have to be able to sell a good deal. So in order to sell a good deal, guys, you got to buy a great deal. That's all wholesaling is. Literally, it's that simple. Buy great, sell good, make a spread in the middle.
Yep.
Right. And a lot of new individuals, they go out and they get a decent deal, maybe not great, right? But it's good for them. But then they try to mark it up 10 grand and it's not good anymore. And they don't sell that deal. You got to buy great and sell good. And then that's the spread. Yeah.
Yeah. Which gives me a little bit of, it's not even really an edge on competition. It's just, I can buy the houses that they can't. Yeah. That's really all it boils down to. And and that's what I've done, you know, over and over and over again. No limit. Dave, let's say that you've got a W-2 employee in Skool, right? Mm-hmm. How many properties can that guy buy?
It's either 10 or 12, I believe. It changes, but let's go with 10.
He can buy 10
in their social security number. Now, if they want to go and create a business and get an EIN and do it, you know, through another entity, which complicates things in a little bit, because they then have to go to the bank and ask for a commercial loan versus just a personal loan. They can get around that, but in their own name as a W-2 without a business, and which often sometimes takes 2 or 3 years to build, right? Mm-hmm. Yes, 10 is the rule. And that's really great about subject to, because you're not subjective, I think's the word, to those rules.
Correct. Yeah, I bought 86 subject to deals here in St. Louis, and
that's so awesome.
Little over 300 across the country. So there's no limit to what you can do, to the amount that you can
300 subject to do. I didn't even know that. That is crazy.
Well, those aren't all mine. I've just told.
So what? You were a part of the transactions?
JV partners.
JVs, man. Absolutely. We got to get you a map with pins in it, dude. That's cool.
Yeah. It's funny, the stuff that you learn. Definitely some lessons there. Tax advantages for buy and holds. a lot of people don't realize that when you buy a property subject to, if you are paying the property taxes on it, you get to write off that mortgage interest. You get the depreciation. You get all of the benefits of owning a cash flowing property that any other investor would, even though that loan is still in your seller's name.
Yeah, it doesn't really matter if it's in their name or in your name. It's who's making the payments is the person that gets the advantage.
Correct.
So I love that. That's so great, because that's one of the reasons why I own 67 properties, I think it is right now. I get the depreciation, I get the tax advantages. It's amazing, right?
Yep.
All the interest that's paid, I get to offset my other income with. So many, and we'll do a whole nother training. I actually have one on the calendar already. It's 2 or 3 weeks out, I think, maybe even less. But it's all about BRRRR and how owning rental properties specifically can make you wealthy with all of these things that Jeff's mentioning right here, all these tax advantages.
You got it. This is the big one, and Nick already hit on this once, but the terms on residential owner-occupied mortgages are unbeatable.
Mm-hmm.
You know, at the one of our best periods in time, we just got through it. You know, even your commercial loans were sitting at 5.25 up to 6.5%. That was at that was at their best.
This is their best. Now they're 6.5 to 8.5.
That's right.
Yeah.
And so what's out there, and this is why you're hearing, subject to, you're seeing all of these people come out of the woodwork now. I mean, you've got people that were that have been, kind of, man, I feel like I'm just picking on them, but they're like a lot of wholesale gurus. Yeah. Wholesale gurus coming out. Now they're all suddenly subject to experts, and they're saying that, now is the best time to get into creative real estate and subject to. But my argument is that as long as these mortgages exist, these mortgages that were written at, and if you've got a mortgage that has a loan mod on it, I mean, you're talking as low as 2%. I've seen them in the ones before.
I've seen some ones before too, man. 1.8,
Yeah.
1.9. It's pretty wild. Yeah.
And so if anyone tells you, it's just my firm belief that anyone tells you that right now is the best time to buy subject to, they honestly don't know what they're talking about, because really anytime.
Yeah. Anytime is the best time.
Anytime you can get a mortgage with a rate on it that is 3, 4, maybe even 5%. I mean, that's just a win. I don't care. I don't care who you are. That's just a win.
Yeah. You're always going to have a better rate going into a bank, getting a loan through your social security number. That's a personal loan.
Mm-hmm.
Then going into a bank, getting a loan on your EIN number, which is a business loan or a commercial loan. It may not be a whole lot more, maybe 0.5%, 0.75%. I've seen them go as high as 2%, right? But regardless, it's gonna be lower. So just to kind of, to drive into Jeff's point here, now is a great time because rates are higher, but 5 years ago was a great time too, because you're still getting that discount. And in 5 years from now, you're still going to most likely get that discount. So I 100% agree with that statement, Jeff.
Well, not only that, you've got
the time is always.
Yeah. But most of these are 30-year fixed as well. So, yep. I mean, find that in a commercial loan.
Yeah.
I mean, there are some products out there.
Such a great point. There's some, but those are the ones. Mike and I did one about, 8 weeks ago, called 2 months ago, and it was 8.5%.
Mm-hmm.
Yeah. 30-year commercial, but 8.5%. And it has 5 years of prepayment penalties. Yeah. So we're getting into the weeds here, but yes, no matter what, all of these, the time is always, it's not just now. Now is great, but last month was awesome. And 3 months from now, it's going to be just as awesome.
Yep. This is just a tool. Really. That's the way we look at it.
Mm-hmm.
All right. Some of the pitfalls, honestly, I couldn't think of a ton on this slide, but if you don't like owning a home, basically, then you're not going to like subject to, because that's what you're doing. You're owning a property.
You're taking possession.
Right. If you don't like the responsibility for taxes, insurance, HOA, none of that stuff, then you're not going to like this. One of the other issues, it's a small issue, especially for a lot of newer investors, but it's the inability to pull equity. Like you can BRRRR out of a subject to deal. You can definitely do that since you're the owner.
Mm-hmm.
But if you wanted to get a line of credit against that property or a second mortgage, you can virtually forget about it. or I'm sorry, not a line of credit, but a home equity line.
Home
of credit.
equity line of credit.
Right.
Yeah.
You can
It's not a
still,
home for you. I mean, I guess it could be. You could move into a property you bought subject to and make it your primary residence. Most investors that I know, they're investment properties, right?
Yep.
So that's probably the main reason there, maybe.
No, the main reason is that your name isn't in the first lien.
It's
position.
on the first lien. Got it. Okay.
Right.
That makes sense.
That's the reason why no lender is going to put themselves in second.
It just increases
position.
the risk for the lender to say, well, what happens about this first one? Yeah, I totally get that.
Right. Yep. So those are really the only downsides, pitfalls, major pitfalls. You have issues where you're dealing. Maybe you have a seller that is, maybe has changed their mind. They have seller's regret later down the road. That might be one of the pitfalls. But if you're playing your cards right and you're doing everything you said you're going to do.
Not only that, Jeff, but if you, I mean, and anybody that's here, hopefully has been on a couple calls with me and knows that, integrity is a big thing with me, but also transparency, right? Like it is very rare that I have a seller or another investor that's like, I'm upset with David, because I try to project myself as being very transparent and having a very high level of integrity. And where I'm going with this is, if you prepare the conversation properly and you tell the seller, hey, my goal here is to have this sold or refinanced in 1 year or 3 years or 5 years,
or never,
which is also a great approach by all means. But if you prepare them with the expectations, that's the word I'm looking for, the expectations, there shouldn't be any issues, right? That's the main thing. So don't go out there and just say, oh, we're going to have this paid off in a year, and then 5 years later, it's not paid off. If you're not planning on paying off, tell them, I'm going to keep this to maturity. So again, that's a little bit of transparency that we're going to want to use whenever we're doing these, because we want to prevent the seller from, trying to get upset with us or having expectations. Again, that's a good word here, outside of what we are planning on doing. Tell the seller what you plan on doing.
Yeah. You don't, if you don't have integrity, you don't want to do these deals.
Exactly.
You're going into what it equates to essentially a business relationship for the long term with a seller. And that's the way you got to look at it. You're going to be, whether you like it or not, you're going to deal with them later down the road. And
it might not be more than just 1 or 2 phone calls a year, or less in some cases, right? But they're going to essentially be tied to the property until it's paid off, sold, or refinanced. Period.
That's right. Yep. All right, let's moving on here. All right, the dreaded due on sale clause. Okay, everyone, we just kind of explained what this is. It's written into all of our deeds of trust and or recorded mortgages, allows the bank to accelerate the loan if the title is transferred without paying off that loan. Okay, there are a few exceptions to that rule.
Keyword there, allows them. It doesn't mean it happens every time.
Correct.
In fact, Jeff's only known a guy or two, or a person or two, and I've heard of a couple of this happening once or twice, but that's out of thousands and tens of thousands of people doing this, right? So it can happen, doesn't mean it will happen. Love that.
Yep. So this, like I said, it's a provision written into every single deed of trust or mortgage that allows the lender to call the note due upon transfer.
And even as a private lender, right?
Yep.
And somebody were to do a subject to deal with one of my loans, I would want this clause. So it's not necessarily a bad thing, guys.
Would you though? I would say, would you though? Would you care about if you're being paid? Would you? That's a good question. That's a good question because I do some lending as well. That's a really good question. I
guess at the end of the day, if the payments weren't being made, it really doesn't matter who the owner is. It would go into foreclosure. So that's true. I guess it doesn't really truly matter.
Yeah. I see why it's there. It's definitely.
But I see why it's there. That's the point.
Yeah.
Right.
Yeah.
Right.
Yeah. So there are a list of exceptions. All right. It's the Garn St. Germain Act of 1982. Essentially, back in the day when, you guys remember or heard of back in the day in the 80s, the interest rates went up to 17, sometimes as high as 20%.
Yeah, it's wild.
All right. So what was happening was these lenders were going back and they were calling these notes due that were written at these lower interest rates. They were calling those notes due. Then they were turning around. They were foreclosing on those properties, selling those properties.
Oh, just because they
providing-
weren't making money on them.
correct.
Oh, that's
Because now they
so
can lend their
crooked.
money at 20% versus the
versus
6,
7
7, yeah,
or whatever it was. Right.
exactly.
Oh
So
man,
that's exactly why this law was created. And so there are exceptions.
so they basically did carve outs to say the bank can't just use this for any reason and let's be honest, on a greedy level. They have
Correct.
to have a true reason behind it, and that's what this outlines. Amazing.
It's
so
the
happy
other
to
way
hear that.
around. It's the other way around, David. It's they can do it, but they can't do it if you fall into one of these 6
categories, right?
9 categories.
Okay,
Yep,
got it.
Yep. And so you can just go out and look up due on sale clause. The Cornell has the official law totally in its entirety, and you'll see the exceptions. One of those happens to be, and I think, David, I love to talk about trusts, land trusts specifically, or revocable trusts. And so one of those ways that we buy properties is through trusts, and we use the Garn St. Germain Act kind of as a smoke and mirrors, or we use trusts as kind of a smoke and mirrors thing to comply with the Garn St. Germain Act. But the reality is, we can buy it in an LLC, we can buy it in our personal name as well, as long as the mortgage is paid.
As long as the mortgage is paid, that's
Yep.
the main thing.
And you guys already know this little secret. Here's a secret sauce to keep your loan from being called. It says Bane. I didn't even notice that. BEI.
Oh, I didn't even notice it either. Being, we know what you mean, Jeff.
Yeah, there it is.
Make the payments. That's right. Be transparent with them on your intentions and have integrity, folks. If the payment's due on the 1st, make the payment, right? And in Jeff's case, he bought, I'm sure, multiple at this point, probably dozens of them, where they have to get caught up a little bit. So sometimes the process of buying the property subject to is catching up the last, payment or 2 or 3 or 4, or however many are in the rears. Now, not every time you go buy a property is there going to be a bunch of money out of pocket to catch them up, but sometimes you may have to catch them up, right? So just know that. But yes, make the payments. That's literally the most important thing when it comes to subject to investing. Literally, make the payments. You're not going to have any worries from the seller or the bank most of the time if you just make the damn payments. Nick, I see a hand. Or is that just a clap?
He's clapping.
Okay. I love it.
All right. So that's it. That's the due on sale clause in a nutshell. It's basically, make the payments and don't have the due on sale clause invoked. It's that simple, really that easy. All right. I'm not going to get into, this is one of the ones I'm not going to get into. Really, I mean, everyone should be marketing at this point. I mean, I don't care who you are, this is a marketing business. And if you're not marketing, your chances honestly, I'm really not even sure why you're watching this, because if you're not marketing, you're not going to be able to actually implement any of this stuff. So
this is a marketing business before it's any.
It really is.
And
It
every
really
business is a marketing business before it's any
100%.
other business. Like, what is business? What is business, right? The definition of it is the act of making money. So in order to make money, you have to have somebody that's either going to buy a product or a service from you. But if they don't know that you have a service or a product to offer them, they can't and won't and will not buy anything from you. So we are in the marketing business, regardless of what business we're in. And when it comes to real estate, we're really in the marketing business, extra so, because again, nobody's going to call our phones and or answer a phone call from us if they don't know who we are. The main thing we're marketing is ourselves when it comes to real estate investing. I love that.
That's correct. Yeah. I mean, and I didn't know that getting into this. I thought, I was doing some advertising on with pay-per-click, but I actually grew. I'm not trained in marketing or anything, but I actually grew to love the marketing side of it. I love it. Like I love, even down to the little creatives, maybe there's some people that kind of just system. I really, really dig into the creatives and the message. I've got a whole stack on my kitchen table, a whole stack of postcards that I get. I just love studying those things.
Yeah, me too. I keep them. I have a bunch of them.
Yeah.
A bunch of them.
So, all right. So we're not going to get into marketing too much here, because that's a totally different ball game. All right. So one of the things that we like to do in my business and with our students is we try to have this shift in focus, this shift in mindset of thinking creative first. And for some of you folks, if you don't have the capital, if you don't have reserves, or if you don't have a savings account or access to capital, this is a must for you. You're going to have to do this. And so this whole approach is based around thinking. The whole approach is based around making your seller your financier. That is the whole approach to that. That's it. Yeah, at least in full or partial.
Not having to go to a bank,
right?
Not having to go to a hard money lender, not having to go to a private money lender, especially not having to use a bunch of your own funds. Now you might have to use a little to catch them up and or to make a payment or two or more if you want to do it for into maturity, right? Of course, but you're not having to go borrow $250,000 to buy a property. You might only need $2,000 to do that.
Right.
It's amazing.
Yep. So thinking creatively, everyone's going to go out. Most people were all taught to go out and make a cash offer, which we do the same thing. The thing that we do differently though, is we always include a creative or multiple creative offers in our offer. So we'll do a letter of intent with multiple different offers. First one would be cash. Maybe we'll do subject to, we'll do some other creative stuff. But the whole concept here is to make sure that you are, it's kind of twofold. One is to switch that switch in your brain that says, hey, I need to do something else here. I can't just give this person a cash offer. What you ultimately want to be doing is you want to create the illusion of choice for your sellers, right? So you give them multiple options to pick from.
With the cash being the lowest, but the one was terms being more aggressive because it gives them, that illusion that they're going to get more. And they are getting more.
100% they're going to get more. They're going to get more. They're going to get more over time. And you'd be really, really shocked at how many people are open to this. This is one of the big, I have some friends that we go out. I don't know if you know Joey DeFranco, but
I know Joey. Yeah,
Joey. So he has these guys' nights, right? So I've gone to a few of them, and we're sitting there and we start talking about this stuff. And one of the big, wasn't even a question. It's like one of the things that the crowd at the table was perplexed by was, how do you talk to these people about taking over their mortgage payment? Like, how do you?
Yeah. What's that conversation look like? That's a great question.
I'm like, well, and it's not an easy answer. There's no easy answer because every situation is different. But the point is that you would be incredibly shocked by how open people are.
Especially whenever they're in a distressed situation, right?
Yep.
Certain people that have tons of money and they're not interested in having, you help them get out of a stress situation. This may not be the best choice for them. But when somebody is moving out of state for a job, or they lost their job and they can't afford to sell the property and the property needs work, right? And they can't even afford to keep making the payments, or as Jeff said in another earlier example, they can't barely afford to feed themselves. You are going to ultimately come in and save them from getting foreclosed on and ultimately save their credit. Like, this isn't just an advantage for the investor buyers like Jeff and myself and the rest of you here on this call or listening to the replay. This is a huge advantage to the sellers that are distressed as well. I can't emphasize that enough.
That's right. Yes, sir. Okay. This is kind of the turning point. This is, if you can wrap your mind around this, and it's a simple concept, but some people either they refuse to believe it, or for whatever reason, they don't even approach this creative strategy. If you can understand, okay, let me back up. Let me give you an example. When I started buying properties subject to, the thought in my brain was, I've got to go out and I've got to save money. I've got to put 20% down I've got to, I've got to put that money down. I got to qualify for a mortgage and all this stuff. If you can understand and kind of flip this switch in your brain and understand that the deal has already been funded, what that did for me was it was a huge monkey off my back.
I've never thought of it that way before, but that's perfect.
It absolutely, it's just, for me, it was a major realization.
Yeah.
That the deal's already funded. So what do you get to do now? What are your choices at this point? Your choices are to either make that lowball cash offer, or understand that the deal's already been funded, and now you can refocus your efforts on building trust and rapport instead of worrying about where that money's going to come from that you're going to use to buy this property with, all the terms of that, going through the whole hassle. What happened in my brain was, all right, the money's already there. It's already taken care of. Let's worry about getting this seller on board with what I'm trying to do here. Right. So I know it seems like a kind of a rudimentary and simple concept, but that's literally the concept that's literally this statement is what is in my brain when I'm on a seller appointment. This is what I think of. And if it's got a mortgage on it anyway. Yeah.
Yep.
Or if it's free and clear, we can talk about other things. But yeah, so that's a big one. Understand the deal's already been funded. So always in our world, we start with our seller first. Remember I said,
now, what do you mean by that?
What I mean is we are trying to make our seller our financier first. So we're not worried about other funds, external funds coming in. We're always trying to create a situation where our seller is willing to finance us in some way, shape, or form.
Got it.
Which, by the way, subject to is a form of seller financing. So that's what I mean by that. Start with your seller first. Shift your focus into building rapport and trust with your seller, instead of going in and, worrying about all the intricacies of, you got to get it for this price. You got to get for that. We honestly, we focus less on price using this strategy than we do on solve, which you kind of should anyway, on solving the situation for the seller.
Yep. And again, that's where the distressed sellers come in. This is going to be a great tool for them. Great tool for them.
Yeah. We get to be super flexible, man. I mean, we're not really tied. We don't have our hands tied with our lenders, with us, setting, we have to get it at this certain price. We get to be very, very flexible. So it's, I guess, one of the other benefits. Real quick, I'm not going to send you a bunch of crap, I promise. But we're going to get into talking about the numbers. So if you guys want to text calc to that number, CALC, I'm going to send you a copy of our latest and greatest subject to calculator. We are going through some revisions on that, but this is the latest and greatest. It's just an Excel spreadsheet, and you have to use Excel. Unfortunately, we do not have it converted to Google Sheets. So that's just so you know that. So we're going to dive into a few of the numbers, what the numbers kind of look like, and some of our criteria for buying subject to. Everybody got this?
Yeah. And I'll add it into the, I'm going to take a screenshot of this real quick. I'll add this into the call replay too.
Also, you're going to, in the response that you get, you're going to get the calculator, link to the calculator. And I think you get these slides as well. I think so. Pretty sure.
Cool. I'll check it out. I just texted.
All right. Okay. Criteria for buying subject to. This is the number one most important question really to any investor, but specifically when it comes to subject to, because we're dealing with margins that are a lot of times we don't have a lot of times a ton of equity built into these deals. So our margins can be, between our purchase price and our sales price can be slim. The most important question to ask is, can the house pay for itself, and how much can it afford to pay? All of us need to have a certain set of criteria that we are willing to, if we're going to have a rental property, we have a minimum standard, generally speaking, No, we're going to have a minimum standard for the cash flow that we want to receive off of any particular property. For me, it's $350. I have to make a minimum of $350 off of every single property every month. And if I can't, then it's probably not going to be worth the headache of me getting into that deal, right? Especially if I'm on the hook to make that mortgage payment. So, so can the house pay for itself? How much can it afford to pay?
Yeah, I mean, that is probably the most important thing, right, Jeff? Because if you're going to take over a property that has a monthly payment of $3,000, but you can only rent it for $2,000, you're going to be out of the pocket $1,000 a month on that particular deal. That doesn't really make a deal in my eyes, right? Like,
yeah, and it's got to be from the get-go too. It can't be. I mean, if you're dealing with something with a smaller spread on between the purchase and the sales price, that thing has to perform right out of the gates. I mean,
right.
You don't.
So if it has an adjustable rate mortgage, that may complicate things a little too, because, you know, it's like, hey, it's going to work today, but it may not if rates keep going up. So it's just something you got to kind of be aware of. But regardless of that, and not getting down that rabbit hole, of course, the house has to perform with the current numbers. That's the lesson here.
Correct.
So keep that in mind.
Yeah. And just to touch on adjustable rate, I'm not going to get down that rabbit hole. We actually have a formula as well that we use internally. Every adjustable rate mortgage has a ceiling.
Has a ceiling. It can only go up so much each year. Right.
Right. So if you go ahead and calculate your deal, calculate your numbers at that ceiling, and you can still make that spread,
Ooh, I like that.
Then we'll go ahead and buy it.
I love
go ahead
that.
And do it.
That's because then it doesn't matter if it gets there in a year or 5 or 10 or never.
Right.
That's the highest payment can be. Use that as, oh man, that's genius.
Yeah. And by the way, on those deals, a lot of time you and I have talked about it. A lot of times our exit on single families is going to be seller financing. We'll turn around and sell that property on seller financing to someone. Who's to say we can't offer an adjustable rate mortgage to our buyer and to offset that arbitrage between those interest rates.
Love that.
All right. Next one. Can I get the deed for little to no money out of pocket? Again, we're talking about potentially smaller margins. So we have to be able to get the deed with, a lot of times with these deals, you're going to have to come out of pocket, or you're going to have to borrow, however you source your funds.
Yeah, but it's not $250,000, folks.
Right.
It's a couple thousand, right? It's not. See, that this is one of the best things that I like about Subject 2 is that you don't need the full price. Oftentimes you just need a little tiny piece to get control. And one of the things that you have here is, can I get the deed for little to no money out of pocket? As a wholesaler, I'm getting control for little to no money out of the pocket, but I'm not getting the deed. Mm-hmm. This gives you the deed, which is like full control. I'm just getting a little sliver of control with the contract. This is full control. I love that.
Yeah, no, you bring up a really good point, because if you're talking about wholesaling, this is why I think Subject 2, this is where you can get a little bit convoluted, because Subject 2 for wholesalers is a perfect acquisition strategy.
It is. Absolutely it is.
Because I just showed you how I showed you in the beginning of this, how I was able to buy those properties Subject 2 and I wholetailed them out on the retail market, right? You can do that all day long with these properties. Mm-hmm. So I think it's a very, very,
and by the way, wholesaling is an exit strategy, folks.
Right.
It's not an acquisition strategy. It's a way to get paid on real estate.
That's right.
Buy great, sell low. Subject 2 is just a strategy to acquire.
Yep.
Right. What you decide to do after the fact. Can you wholesale a Subject 2 deal? Absolutely. Can you wholesale a Subject 2 deal? Absolutely. Can you get even more creative and use the Subject 2 on the acquisition side of the deal to get control, and then do like Jeff's saying, and then seller finance it to the buyer? Absolutely. That's the exit side, right? Subject 2 is the acquisition side specifically. Keep that in mind.
That's right. All right. Next question I asked myself: will any repairs move me into negative equity territory? A lot of times, as we know, a lot of us are looking for ugly houses. I am not necessarily averse to moving into negative equity, but there's going to have to be, first of all, it's got to be in a great location. It's got to be a great location, because you want to get out of that negative equity territory as quickly as possible. If you are in a great location with great schools, appreciation alone can pull you out of that territory. My only concern really is this going to cash flow for me? Even if I'm in slightly, 3 to 5% negative equity, does this thing cash flow for me? I've overpaid for it, obviously. Does it cash flow? That's really all it boils down to me, is cash flow. But if I'm going to do that, like I said, it's got to be in a really, really good area. It's not going to be, it's not going to be a rental area. It's going to be an area where, if I sell or finance to a buyer, I can rely on that appreciation as my insurance in that deal. Okay. So I hope that makes sense. All right. Is there any front end income, an option payment, or down payment? I really love to be loaded on the front side with particularly a down payment. I don't do lease options anymore. If I'm going to dispo a property as a cash flowing property, it's either going to be a rental, straight rental, if it's in a rental area. If it's in an area that will support buyers with a decent down payment, then I'll sell it on seller financing. And so it's a big deal if I'm going to go out and I'm going to make repairs on a property, say $25,000, but I know I can get a $20,000 down payment come straight back to me. I know I've only got $5,000 wrapped up into that deal. And a lot of times we do that we make essentially what we do is, a wholesaler makes an assignment fee. We don't make as much as a lot of assignment fees, but we make pretty close to what a lot of wholesalers make in assignment fees through our down payments.
So your down payment on the exit side.
Yep.
On the exit. Yep.
Yes, sir. Yep. You got it. The big, most important thing to me is there a monthly spread in cash flow? Must be a monthly spread. And as I told you, I need $350 per property, per unit, for there to be a spread, unless it's a multifamily, which I own a couple of multifamilies now. So is there a monthly spread? Is there a spread between the purchase and the end sales price? Not as important to me, but it's still a question that needs to be answered.
I love this, Jeff, because most people, I think, are going to probably be more concerned about that last bullet there than they are the previous one, right? They're probably more concerned, but really it's backwards, folks. You should be more concerned on the monthly spread than the end spread, because by nature of any loan, it's paying itself off over time. And I don't know about you guys and girls, but if you look at the news, the value of our dollar ain't going up, it's going down with inflation. So you have two market forces. I think that's a good thing, or a good way to describe that. But you have two forces, one being a market, one just being math, right? That are going to help the spread get bigger and bigger every day. It doesn't have to necessarily be a huge spread on the amount owed and the true value of the property today. Time will help fix that problem. The monthly spread today on what's owed to the bank each month and what you collect is what matters. Jeff,
100%.
I knew that, but like putting it in front of you and talking about it and bringing it to light is super valuable, because that's really what matters. I love that.
Let me ask you a question, Dave. Have you ever been cash poor?
All the time.
Yeah.
2 or 3 times a year, I'm like, oh man, I need to go raise some more money or sell a property. It happens all the time.
Isn't that the worst feeling on the planet, though?
It sucks.
It's awful.
Yeah, absolutely.
Yeah.
And it's
So
only because I over leverage myself, or, that happens. It's not going to take me down at this point, but it is a terrible feeling when you're like, man, this rehab's $40,000 over budget.
Yeah.
Like, how am I going to make this work? All right. Absolutely.
Yeah. So that's where, I spent a few years back, I went through some pretty crazy stuff, and I thought I had myself set up really, really nicely. And kind of long story short, next thing I know, I'm like, Jesus, my mortgage is due. My mortgage is coming. And I was really, really hurting.
Mm-hmm.
But on paper, I owned a couple $1 million in real estate, but I had no income. It was all tied up in these projects and all these deals. And so that's when I decided, I was like, you know what? Nothing else in this world matters. The equity that you have sitting in that property is not going to pay your mortgage payment.
No,
it is not going to pay your car payment.
You can't eat equity. You probably heard that before. Can't eat it. You can capture it. It's not necessarily, it's liquid, but it's not liquid. You
Yeah.
know, it takes a month or 2 or 5 in some cases to get the equity out of the deal. The cash flow is really what matters day to day.
100%.
Absolutely. Absolutely.
100%. Yep. All right. So let's go over real quick. Here's some of my personal buying criteria. This may not be, it just depends on how risk averse you are. But here's some of my personal buying criteria when I'm buying properties subject to. All right. I always like to purchase homes that have the largest buyer pool. So that's going to be your middle class, blue collar areas, B to C minus areas. I love those because no, we don't get the largest down payments on those.
Yep.
But we can get the name of the game is speed here. Speed. We can buy a property. We can sell a property as is on seller financing if we're marketing to the right buyer pool. And we can do it quick, super fast. Within 30 days, we can have it done. All right. So I purchase homes within the largest buyer pool. I don't go out and buy these $500,000 houses, or $300,000 that need $100,000 in work and turn around and sell it for $500,000. Because
now let me just say one thing. That's relative to your market.
Correct.
Like Jeff and I live in the St. Louis metro area, and the average price of a home here is $235,000, I believe. I could be off by a couple grand, but it's about $230,000. So, anything within 30 or 40 grand of that number or lower is going to have the biggest buyer pool.
Yep.
Whereas $700,000, guys, the buyer pool is tiny. Now, if you're in San Francisco, that may be different. So obviously just figure out what the median home price is and try to stick to a bracket that's very tight around that, because that's where the biggest, amount of buyers are going to be. Love that, Jeff.
Right. Yeah. And I want to back up here. If you download that calculator, the calculator is going to walk you through a few things. You put your acquisition assumptions in there. So you're going to put all your numbers from, maybe the latest mortgage statement. It's a subject to calculator. That's really what it's designed just for subject to deals.
Sweet.
So if you look at that calculator, and then it's got a bunch of little different exit strategies in the different tabs at the bottom. One's going to be seller finance and on. One's going to be rental. There's a little switch that if you fill out the acquisition assumptions, then you're going to seller finance it. You fill out those numbers, you figure out what those are. It'll turn red or green.
Oh, that's easy. Can't beat that.
So I will tell you this though. If you're living in one of those markets, I've got a friend that lives in DC. The average price for a 1,500 square foot home is $800,000.
Yeah, it's crazy.
You're going to look at that calculator and it's going to tell you no, that the deal doesn't work every single time, because obviously you don't have the it uses basically the 1% rule.
Sure.
And so a lot of those higher priced markets, you're not going to be able to hit that 1% rule.
But that's okay though, because it makes sense though. If you're like, I don't know very many $800,000 properties that rent for $8,000 a month.
Right.
and so it doesn't matter, right? Like what matters is the cash flow.
Yep.
So unless you're getting $8,000 a month, you owe the bank on an $800,000 loan $6,000 a month, $6,500 a month. If you're not bringing in $8,000, it doesn't work. If you're really bringing in $4,000, that's negative cash flow. The calculator's working. Yeah.
Yeah. So this is where we talk about how comfortable you are with the spread that you want to make on every deal. So it might be an $800,000 house, and you're making $350 a month. If that's your minimum, then the calculator is not going to tell you that.
It's going to tell you how much rent you're going to need to collect to get to that number. Right.
Yeah. So, all right. So middle to upper class, middle class median price range. That's where we like to stay. Good schools. I can't emphasize how important location is. Location is probably, we've got the difference between here in St. Louis. We've got St. Louis County and St. Charles County. Good luck finding a house in St. Charles County. It's a great place to be.
It is. It's hard to find deals out there, man.
Yeah. Yeah. Low crime rates, obviously. Okay. Here's what I offer.
Wow.
On my subject to deals.
I
am not afraid to offer 90 to 95% of fair market value. Difference between ARV and fair market value can be massive depending on how much you need in repairs.
Yep.
Right. So you calculate fair market value. It's ARV minus repairs. That's it. What will it sell for today?
There's no discount rate essentially calculated in like a wholesaler would do, or a fix and flipper even.
Right.
But I want to emphasize this just for 1 second, guys. Fair market value is not what Zillow says it's worth. Fair market value is what the comps say the ARV is minus the cost of those repairs.
That's right.
That's the fair market value. Now, as a wholesaler or a fix and flipper, I may even throw in another 15 or 20% discount, maybe even 30% discount on top of that. But Jeff doesn't have to do that. He can get more competitive, which allows him to buy more deals. Keep that in mind.
Right. So yeah, we'll offer 90 to 95% of fair market value if the property is occupied, 80 to 85% if it's vacant. I'm sure you can assume why we do that, right? The difference between occupied and vacant.
Yep.
90 to 95% is going to give them a little more motivation to get out of the property. So, all right. This is what I really, really like to have. The area demographic must have a buyer pool that can afford at least 10% down payment if I'm owner financing it.
Which goes hand in hand with great or good schools in middle to upper middle class, right?
Yeah, you're drawing the picture here, man. That's
I mean, all these things go hand in hand with each other, which is, I love that, right? So you don't necessarily want to be in the crazy high net worth areas. You don't necessarily, I mean, you could do that, but it's going to be more difficult. You definitely don't want to be in the war zones, guys. Nobody's going to have the money. The schools are going to be awful. The crime's going to be through the roof, you know. But the great part about this is this, in my opinion, is probably, I don't know, help me out here, Jeff, 60% of neighborhoods.
You mean that can afford 10%?
That fit middle to upper middle. Yeah.
Oh yeah, at least.
I mean,
yeah. You'd be really, really shocked.
51% or more, right? It's the majority.
Yep. Yeah, I mean, I don't want to get down the owner finance rabbit hole because I can talk about that all day long. But
sure.
You'd be shocked, surprised at just how many people the pool that you have, the pool of buyers that you have for an owner finance exit is freaking
massive.
Bananas.
It is. It's massive.
It is crazy. So, all right. So the one drawback to this is this might exclude a lot of first-time home buyers because, you know, a lot of first-time home buyers are going out there either VA or FHA. So you've got 0% down, you've got 3.5%.
They have to have the 10%.
Yeah. But you got to have the 10%. And those people exist. They are out there.
That's only if you're doing an owner finance or seller finance. In this case, you'd be the seller, right? This is post-purchase.
Right. That's why it's a sub-bullet point. Yeah.
Yes.
Exactly.
Yes.
Yep. But it might not be bad criteria for a retail flip. You know,
man, that's one of my favorite ways to use subject to is to source the rehab funds, but not have to buy the house first.
Yeah.
Essentially, it's another way to word it, in my opinion, Jeff. Even when I'm doing subject twos, is I'm joint venturing with the seller.
Yep.
That's exactly how I look at it. I'm joint venturing with the seller. I'll make your mortgage payments for 6 or 8 months while I fix it up. You have zero cost here. Zero. Yep. And whenever they're willing to work with me, that not only am I going to pay the mortgage off and get them hopefully some money to walk away with, I'll even give them more money to walk away with if they're willing to work with me in that joint venture scenario. It's just taking subject to a seller as a joint venture agreement versus I'm going to help you out of a hard time. You can do both. That's what's so great about this.
Absolutely. Yeah. I mean, this goes back to that creative mindset thinking is, you know, how can we make this deal work? And, you know, my goal is to be in it with as little out of pocket as humanly possible. And I can still make you X amount of dollars, you know, Mr. or Mrs. Seller. All right. Good deal. Now this has to be changed. My minimum is now 350.
You went up.
I had to adjust to inflation.
Nice.
Yeah.
Nice. Yeah. Love that. Yeah. 300 is still not bad, but 350 is even better, right?
Yeah. Yeah. It's totally doable too. If you,
see,
that's
Tammy,
the great thing about terms, man. Terms allow you to build this, build an offer. They allow you to build this whole strategy. And, you know, in the same amount of time that it takes to come up with or maybe just a little bit more, but same amount of time it takes to come up with a cash offer. I mean, you're right there. You might as well. Yeah. Anyway. All right. Negative equity criteria. House must be move-in ready. Possibly maybe need flooring. Everybody knows, like people can deal with paint. People can deal with paint even, I found.
Even when I turn a rental over, I'm painting and typically messing with some flooring. So yeah.
But people don't mess with flooring. They don't. If you got dirty floors, people don't buy houses. For some, that's just
it's the biggest part of the house that you're seeing and you're touching, no matter what. Unless you're flying around, you're touching the flooring. Yeah, definitely.
Yeah. My rule of thumb is like, if I had a mother with a newborn baby and she had to set it down on the floor, set the baby down on the floor, then if she wouldn't do that, then it needs new flooring.
It needs new flooring. I love that. That's a great approach.
Again, great locations. If I'm moving into negative equity, great locations and great schools. 3% negative equity max. I have gone up to 5-ish, somewhere in that area.
But it cash flowed, I'm sure, so it worked.
Has to. Yep. Historical growth trend. This is what I talked about before. If I'm going to get into negative equity territory, it's got to be in an area that, if you go out to Truly, or if you go out to any of these websites that you can look at growth trends or appreciation in those markets, then absolutely, if it's got a great growth trend like we've had here in St. Charles County over the past couple decades, then I have no problem going into negative equity territory.
Awesome.
All right. Here's this is probably more important to know than than actually when or how to buy subject to. It's when not to buy subject to.
A big part of all of these trainings here are this right here, guys. We are here to help and teach and coach and give you the information. And a lot of that information is how to do things, and some of that information is what not to do. And personally, I find this part of the presentation, or of any presentation, some of the most valuable things, right? Like, avoid doing these things so you don't get into trouble.
Yeah. And number one on the list, it has to do with the seller. Problems with the seller. A seller can ruin your day. They can ruin your day, particularly if they are a litigious seller. So part of our line of questioning and part of our rapport building at the rapport building aspect is keying in on little things like, the things that the seller is telling you. For example, if I go out to an appointment and the seller says, well, I can do this, but, my brother's an attorney, and, I'm going to have him look at this. That's one strike. That's actually 2 strikes. If they start talking about attorneys or threats or anything like that,
it's going to be an uphill battle the whole time. Why even try to fight that?
Yep.
Yeah. If they're not motivated, it's probably not the best strategy. And if they're mentioning anything with attorneys or any of that, again, it's like, all right, maybe a cash offer might be a better option in this scenario.
Yep, for sure.
We
all know that the only people that win in litigation is attorneys anyway.
That's it.
I'm not on that page, man.
Agreed.
Problems with the house. Many subject to deals have very thin. Look at my spelling.
I know what that means, though. It's equity.
You know what it was? It's Latin. It's Latin.
That's Latin. That's right. You're all still going to get a lesson in Latin today, folks.
They have very thin margins. Any extra expenses can kill these deals pretty easily. So stick with decent houses. And that really pertains to if you're going to be seller financing the house.
Totally.
Again, don't want to get off on a.
Yeah, location. Yep. That's real estate, folks. It's always hyper local.
Yep. Problems with the numbers. Do not buy a subject to deal just because you can. If you've got a seller that is willing to hand you the deed, but the deal doesn't make sense, the numbers don't work, don't buy it just because the seller is willing to do it. That's the dumbest decision ever.
That's not smart.
So the numbers must always work in your favor. And we talked about those multiple offers. If you have cash offer, you have a subject to offer, you might have a couple other seller financing. Any one of those offers has to work in your favor. No questions asked. It has to. And the property must always pay for itself from the get-go, from day one.
Good stuff. That's awesome.
All right, real quick. I don't want to get too crazy into this.
High level. So entity structure and trust, we buy them in 2 ways. We buy them in LLCs, or we buy them in revocable trusts, and or we're not a land trust state. Excuse me. So we use a revocable trust. Right. So hold on really quick, just because I don't know this. I didn't even know that there was land trust states. what does that even mean? Just give me just 1 minute if you don't mind.
Sure.
On that. I this is totally over my head.
Sure. There are
I thought I knew this, but I have no idea what you're talking about right now. So help me learn.
So a land trust is specific to real estate.
Okay.
And so a land trust, there are states that have statutes on the books. Hold on.
You're okay.
Been outside in this allergy.
Yeah,
pollen.
allergy season here for sure, man. My car was covered in pollen yesterday. Covered in it, like half an inch. It's crazy.
Yeah. So there are 6 states that have land trust statutes: Alabama, Florida, Illinois, South Dakota, Hawaii. And I'm missing one. I can't
Doesn't
think of the
matter.
other one right now.
Yeah. Okay.
And those are land trusts are specific to real estate.
Okay.
You can actually do business. You can create a land trust in Missouri that complies with the state of Illinois, for example. But then all your court cases, if you happen to go to court for that property, it has to be taken care of in Illinois.
Okay.
So we've got 44 other states that do not have land trust statutes. So we create revocable trusts. They're effectively the same.
It's effectively the same thing. It's just named differently, right?
Yeah. Yeah.
Got it. Okay. Kind of what I figured, but again, I know there's people here live and or on the replay that are going to have that same question. That's why I asked.
Right. So we buy them in either trusts. We're going to call these land trusts because they're effectively they're put together the same way a land trust would be, but know that it's a revocable trust that we use.
Makes sense.
Or we buy them in LLCs. And I'll tell you, I'm a huge proponent of trusts because when I got started in this business, give me 1 second, okay?
Yeah, take your time. I know that you were when we first met, you were using LLCs, but again, that was 8 years ago. And then I had you out to my office, I don't know, 2-3 months back, probably not even that long ago, maybe a month and a half ago. And you were like, man, trusts are the way to go. Trusts are the way to go. So you've probably been using them for, a lot of the time since I've known you. But I remember when we first met, you never even mentioned a trust. We just used an LLC. And I'm like, oh, cool. Teach me some more. This is great.
Yeah, it's been an evolution, really. So the way that the lesson that I learned with using LLCs is that let's see, this was 2000. In 2018, I was so far behind on taxes. I'm sorry, 2019, I think it was. I gathered up all my paperwork, all of my entities, all of my LLCs, handed them over to my CPA and said, here, do this. I had
they were loving that.
Yeah. No, I'm a star client, man. But we had 21 LLCs. Wow. And
I thought I got a lot. I got 8 or 9 of them. I don't even know. I think 9, 8, something like that. 21. That's crazy.
Well, it's simple for a reason, because it's a total pain in the ass on the back end. Because in Missouri, and these were Missouri LLCs, I've wised up to where LLCs really should be created. But they were Missouri LLCs, and in Missouri, we require a tax return for every single LLC. So the business gets taxed, you get taxed, and you have to maintain their books and their records on 21 different LLCs.
Yeah, that's crazy.
Not to mention just the cost of of completing the returns.
Mm-hmm.
So we had this massive bill, and now it's not that big of a deal where, I'm having to go out and manage all these different LLCs, because we all know, like, some of these are just for holding real estate. It's really
for sure. But the trust gets you around that.
The trust I own 5 companies, but for my real estate, I operate out of one company, one LLC.
One EIN, essentially.
One EIN.
Yep.
Essentially, I don't know if you guys can see it back here, but I have I have a little black and white printer. And my trusts, once I had them created and vetted and everything, my trusts get printed off of that printer right there.
So you're not having to go to an attorney every time to do this. Nope. You just print it out, give it to the seller, or sign it, do whatever you need to do. The seller doesn't even need to sign the trust, really, right?
Just depends. I won't get into it, but it just depends on the situation.
Right.
whether or not they need to have some sort of membership in the trust.
Yeah, but regardless, high level, it's either a
Yep,
revocable trust, could be a land trust in some states, but revocable in most, and or an LLC. That's
An
it.
LLC.
Now, you mentioned earlier you can do this outside of these in your personal name, but why would you recommend these two approaches versus just David Dodge buying directly from Jeff Coffman here? Almost called you Hoffman. I know your last name.
well, number one, the tax, the tax benefits. Of course, remember we talked about due on sale clause. Due on sale clause. This is where I get a little uncomfortable talking about, because it really is smoke and mirrors is what it is. So essentially, we use trust for the reason I stated before. I don't want to have to manage all those LLCs. Trust and the trust. If you can think about,
but it's not illegal. That's the thing, right?
Correct.
Smoke and mirrors, sure.
yeah,
But it's not, you're not doing anything illegal. You can't get sued and fined or put in jail because you're opening an LLC or a trust. And
That's
when
correct.
When you say smoke and mirrors, you're often creating the trust or the LLC. And it may be, in the name of the seller or the address of the property or something along those lines, but they don't own it anymore. You do. And the reason it's smoke and mirrors, I just kind of want to define this for anyone that's listening or watching. It's going to make it, all you're doing is you're just making it a little bit more difficult for the bank to see that the seller doesn't own the property anymore. It appears that they do, even though in reality, Jeff does, or David does, or you do.
I don't own anything
anymore.
All of my trustees own all
the
of
trustees own it. Got it. Even more so. Right.
Right. And that's totally legal to 100%. There's nothing wrong with
nothing illegal about that. Right.
You're just trying
Smoke and
to
mirrors,
not push,
I like that, but at the same time, it kind of gives it a negative connotation.
It does.
But it doesn't have to, and it shouldn't. It's just we just explained it, but we need to explain why we're saying it that way. Because again, the idea here is not to break any laws. It's just to kind of, it's not really the bank's business. If they're getting paid interest, what do they care?
Yeah.
I mean,
exactly.
Seriously, what does it matter? We're not here to harm anybody or to break laws or to not have integrity, right? This is the one time where we're not going to go above and beyond to be ultra transparent with the lender. Now, we're going to do that with the seller. Right. We just don't necessarily want to wave a big white or red flag above the property saying, hey, I'm the new owner.
Yeah.
It's not anybody's business.
Yeah. Yeah. And it's, you hit the nail on the head. It's not illegal at all. It's just, you're not wanting to raise your hand and go, hey, here's what we did. Although we do notify our lenders that a property has been transferred into a revocable trust.
Yeah.
So we're transparent in that nature. And and there's even provisions, Fannie Mae even has provisions now for transferring properties into LLCs. That's very common. People do it every single day.
People do it all the time. I transfer properties in and out of LLCs all the time.
Yeah. See, so it's not a big deal. It's really not. It's I think if you get out of the mindset of needing permission to do this stuff, then I've just never been much of a rule follower anyway, to be honest with you. But yeah, so I mean, totally, you can be transparent with them at the same time and still no question do accomplish this goal, right?
For sure.
So
cool.
All right.
Entity structure. Don't overthink it, guys and girls. This is not rocket science, but this is going to be the most efficient and I think the better word here is effective. It's the most effective way to do this, to protect yourself, protect the seller, and to just get the deal across the finish line so you can gain control of the property and start making money. That's why we're here, right? Why are we here? We're here so we can learn how to make money. Yeah. And this is just the tool in which we're doing it here. Nick says, I'm starting off as an LLC, and that's totally sufficient, Nick. Yeah, absolutely.
Well, and Nick, let me kind of interject there for just one second.
Sure.
What we do recommend, though, if you're going to go with LLC, we don't recommend you buying the property in your main operating LLC.
Create a new one for the deal.
100%. Yeah. It gets its own.
And Prime Corporate Services, who I just had on yesterday or the day before, can help you set all this stuff up, Nick, as well, too. Keep that in mind. Absolutely.
Yep. All right. There we go. I think my battery's going dead in my keyboard here.
Uh-oh.
All right. So again, I'm not going to get crazy into this.
Yep.
I prefer using trusts over an LLC for managerial issues. I just a trust is, once you understand the mechanics of a trust, they are so incredibly powerful. It's crazy.
It's better. Yeah, for sure.
Both methods are really easy to set up. Tax ramifications are generally the same. Both methods are 100% insurable with a title policy. No question.
Love that.
And if you can't find a title company that will not write you a title policy using a trust, then you probably need to find another title company.
Mm-hmm.
And then, Nick, here we go. One property is one LLC or one trust.
I buy properties all the time from people that have them in LLCs and in trusts.
Yeah.
I mean, it's super common. Super common.
So we that's the way we set our trusts up. Our trusts are properties deeded into the trust. We have a trustee, and then our company is the beneficial owner of 100% or whatever percent beneficial ownership in that trust. So they're very flexible. I mean, extremely flexible and totally transparent. I mean, not transparent's not the word I'm looking for. What's the other word I'm looking for?
They're trying to think of
it all operates privately.
That's what. Yeah, you get some anonymity. I can never say that word. I think I actually nailed it on that one. Usually,
you did. You did a good job.
Yeah,
proud of you. Man.
Usually, it's like, woo! I don't even know what I just said, but you get some of that with it, right? So you get some protection in terms of being able to kind of hide who the real owner is.
And there's some asset protection built in there. Not much, because a trust can be easily pierced.
Right.
A trust can be sued. But there is some asset protection. So that's why another reason why we say one LLC or one trust per property, because if a trust gets sued, the only asset in that trust is that particular property. The only asset, if you buy an LLC and create an LLC and a bank account, the only assets are that property in the LLC.
Do you recommend doing it that way though? One property per one LLC and or trust, opinion. You don't necessarily need both, but
I do it that way. It just depends on your level of
tolerance of risk. Yeah. Got it.
A lot of people do 5. I think 5 is a really common number to put one property. But then again, if you go combining those, if you buy, say, 5 properties subject to, and you put them into one LLC, well, what can you do with an LLC or a trust that if they were standalone versus
you can sell them?
That's right. You can sell.
Yeah. If you have LLC, 5 properties in one LLC or one trust, it's going to be difficult to sell the whole package because they're going to need a buyer to buy all of them. Whereas if you have one, you may have much more opportunity to sell it. Now you can move it in and out as well, but guys, it's better to just set it up the right way in the beginning. Way less bookkeeping and tax implications and management. So I don't want to get too deep down that rabbit hole by any means, but I love that. One property per LLC, especially if you're new. Keep it simple. Don't overthink it.
That's when we're talking about subject to, by the way. I just want to make sure that's clear.
Yeah. For subject to. Yeah. So for me, for example, I got 3 holding entities that has 67 properties in them. Each one's got anywhere from 20 to 30 properties in it. That's totally fine with me because I'm not necessarily looking to sell one of those out of there. And if I do, I could even move it out if I had to. But yeah, subject to specific here. Love that.
Yep. All right. Here, I'm not going to go crazy with this.
Yeah, that's all right. No problem.
Everybody knows LLCs provide limited personal liability, recognized in all 50 states. Different fee structures. This is something you got to be careful of. I mean, personally, all of my LLCs are now Wyoming LLCs. I love Wyoming's just a fantastic place to do business in. Just be careful about where you're creating these LLCs. If you're going to buy multiple properties, if you're going to buy them in Missouri, either create a Wyoming LLC or just buy one local. I mean, just buy a Missouri LLC. Just understand you're going to have to file a tax return on that.
Right.
So
again, Prime can help with all this stuff, guys. We're not here to give you, advice on, this or that by any means. Jeff's just telling you what he's doing and what's working well for him. If you don't have LLCs or trusts, Prime can help. And there's tons of links to connect with them and book a free strategy session even to learn, what would make the most sense for you. And that may change. Like what makes the most sense for me today may not make the most sense for me in 3 years from now, because I may do things differently and change the way I operate my business, so just keep that in mind.
Yeah. Also, you're going to have different companies that are going to want to offer different things. This is literally just what I've learned over the years. And so I've honed it to make it much more palatable to myself. Mm-hmm. So a little interesting fact: Canadians investing in the U.S. are subject to double taxation if you use a U.S. LLC or a trust, for that matter. So, all right, LLC. See, this is where I don't want to get into the weeds. Limits personal risk.
Yeah, we'll just fly through it, man. No problem.
Yep. Ease of setup, pass-through taxation, management flexibility, and insurability. They're very, very common. No problems at all.
Perfect. Love it.
Why is my...
There you
go. Expense and hassle. I told you I had 21. Registration fees. What you have to file. Some states have to do foreign or domestic. Although there are most states have an exception for real estate. Registered agent fees, maintaining good standing from year to year, an annual fee, all of that good stuff. And then possibly a separate tax return for each LLC. So
you don't have any of that stuff essentially with trust, though.
I don't have any
great.
of that.
That's awesome. So all the more reason to set a trust up then.
That's right. Yep. All right. So a trust, we're talking about land trusts. It's a contractual agreement. We're not talking about real estate here. We're not talking deeds and means and ways, none of that stuff. We're talking about a contract here, right? Totally different ballgame. The trustee takes title to the property. So you no longer own the property. The trustee actually owns that property. All right. Trusts themselves, they can be taxed. If you want an EIN, if you want the bank account to have if you want your trust to have a bank account, it's going to need an EIN. We don't do that. We just do straight pass-through trust. Our beneficial owners, people that own the beneficial membership in the trust, are the ones that get taxed. Your beneficiaries can be real people, any flavors of the following corporate entities.
So it can be me. It could be an LLC or a business that I own.
It could be
and
multiple.
Then of course there's multiple, right? And there's lots of different classifications here as well. And we don't want to get into the weeds on this, guys, but just know that the beneficiaries can be basically anything, right? It can be businesses, other trusts, persons, multiple people, however you want to structure it.
Don't let your head explode, Nick.
Yeah, it's not. Don't worry about this in terms of having to know any of this, because this is not important. PCS can help you set this up, and each thing, there's multiple reasons to do it different ways, and that's all going to be specific to you and your needs and what you're trying to accomplish. So again, don't necessarily think you need to know and learn all that stuff.
Right. Here are your players in a trust: trustee, beneficiaries. That's really it. Beneficiaries tell your trustee what to do. Your trustee is basically there to sign paperwork. That's really what their role is. Okay.
Trustee is kind of the manager. The beneficiary is essentially the owner, right?
Correct.
Okay,
although
perfect.
Beneficial membership in a trust is considered personal property. So we understand.
Interesting.
That's why, sometimes a director, I'm not going to talk about.
Do you have to pay personal property taxes on real estate outside of the real estate taxes? That's exempted then?
Correct. Yeah. If there's no personal property exchange, then no.
Perfect. Oh, good job. Okay.
There could be a taxable event there. If you buy and sell beneficial ownership. So if I bought a property for $100,000 and I and I sold my beneficial ownership for $150,000, I might have a taxable event on that $50,000 that I own. I will have a taxable event. And it will be personal property. So, all right.
Interesting. Okay.
I mean, honestly, I could talk about trusts. I could do another whole Saturday on trusts. Honestly, it's just all of these benefits: anonymity, privacy, flexibility, versatility. The beneficiary can be one or more corporate entities. No registration or upkeep with the state once it's created. It's just a one and done type of deal, and they're fantastic to work. They're fantastic to use. Some of the disadvantages. I have this dream of getting everybody on board with using trusts because of the previous slide, that the items mentioned. There are so many benefits to using a trust. The number one thing, when people say anonymity in a trust, I don't think they really understand what that means. Anonymity keeps prying eyes of everyone. It's not just you Dave going out and marketing, going, damn, this is in a trust. Who do I send this to? It's not just that. It's literally the county, city governments, municipal governments. They're all blind to what's going on inside this trust. All right.
That's awesome. That's great.
So the learning curve, traditional title companies a lot of times don't know how to deal with trust. They won't deal with trust, so they won't write you a policy. Some insurance carriers on how to set up insurance, they might not understand this. And honestly, government's the worst. We've got a couple of Section 8 houses that they just do not understand what beneficial ownership means. They do not understand it. So, and this is another one too. They can be intimidating. So Dave, if I bought a property and I was going to say, Dave, hey, I'd like to sell you this property. You go, okay, how much do you want for it? I say, well, I'll tell you what, how about I just sell you beneficial ownership for $50K? I'll sell you my beneficial ownership in this trust for $50K. Now, a lot of people, you probably know what that means, but a lot of people are just going to scratch their head and be like, I don't even know, where do I begin here? But if you really, this is why I encourage everybody to go out and learn about these trusts, because I can sell Dave 100% beneficial ownership in a trust for $50K. Nobody needs to know about it at all. That trust already has a title policy in place. It has hazard insurance on the property in place.
And that's huge, because usually whenever you're transferring things, you have to then transfer all the other stuff and start over and repurchase these things. But those can move. You're assuring the trust. Who owns the trust is not the business of the people giving you the policy.
Correct.
That's awesome. Holy cow.
Yeah,
I knew
big.
that, but I
It's
forgot.
huge.
And I'm so happy that we're talking about this again.
It's a
That's
huge
amazing.
deal.
It's a huge deal.
And you can
Title insurance
literally-
isn't cheap. You're talking, anywhere from $1,000 to $10,000, depending on the price of the damn house or the property, so.
Here, I'm going to show you something. I'm going to hold this up. I don't know if you guys can see this or not. So I just had beneficial interest. I just bought beneficial interest in a property, right? This is 2 pieces of paper. This is it.
That's it. Two pieces of paper. Simple.
And I now own beneficial interest in a trust that owns a property that I'm taking over subject to.
It's awesome.
That's simple.
So awesome.
All right. Do we want to talk about this, Dave? I mean, I think it's
yeah, let's just brush over it real quick.
Yeah.
I'd really like to try to wrap up in maybe the next, 10 minutes, Jeff.
Yes, sir. Yes, sir.
I'm not
You
trying
got
to rush you by any means. I want to keep the trainings, in a relatively consumable time frame. So yeah, let's touch on it, but we don't have to dive too deep.
Don't think I did. Don't tell me I didn't warn you. I told you I could. All right, things
Jeff,
to avoid.
I'm happy you're here, man. Thank you so much for your time and coming here and helping, just provide value to this community. I'm pouring my heart and soul into real estate school, and you're a big part of that. So thank you, man.
Awesome, man. Good deal. All right, guys, talking to sellers. Okay. This is again, less about what you say and more about what you don't, or what you do and what you do and what you don't do. All right. So things to avoid when you're talking to sellers. Don't get technical with folks. All right. If you're going to buy a property in LLC, hey, I'm going to buy this property in LLC, Mr. Seller. Is that okay? Yeah, sure. Fine. Mr. Seller, I'm going to buy this property in a trust. Is that all right? Yeah, that's fine.
It's all that matters. Don't dive
it.
deep down that hole and try to explain to them what that means. Just say what Jeff said and move on.
I'm telling you, especially with trusts, you will lose them. I have lost sales. I've lost.
Nobody wants complicated. Nobody does.
Yep. Don't fake it until you make it. This is hugely. This is just such a common mistake. I mean, I know, if you're a wholesaler out there and you're just getting started, credibility is a huge issue. Like, a lot of people have a lot of problems with it. Dave, you actually helped me kind of overcome this. You had I think a video out there about creating a credibility kit, and that's actually what I did. But honestly, the key to this is understanding the process, understand what's going on. And if you don't know something, you got to be totally transparent about it. And you've got to follow up and you got to get back with your sellers. That's all there is to it, especially with these, because like I said, this is going to be a long-term relationship. Don't fake this. Don't mess this up. Just tell them what you are. If you're brand new, hey, I'm brand new to this. I'm working with somebody who's helping me out. That's all you got to say. All right. Never make any promises you can't keep. Goes back to the integrity thing.
Mm-hmm.
Here's the one on the bottom. Don't put in writing your timeline for paying off their loan. I can speak from experience there. I have done that, and I probably will still do that, but I try to,
because things can change, and you don't want to put yourself into a box.
Yep. Look at the difference between last year at this time and this year. I mean, look at the housing price. Like, I have no idea what's going to happen. So I don't like to put that in writing. I will make them a verbal promise.
Right.
But it's very hard to put it in writing. And
yeah, because things change, and that promise is based on, market conditions and expectations, but those change.
Yep.
So I love that. And I agree with that as well.
All right. How to make your life a living hell. Make promises you can't keep. Reserve your very best sales pitch for your meeting with a seller. You and I have talked about this. Be a closer. How many times have you heard that?
Mm-hmm.
Go, always be closing. Always, dude, I'm never a closer. When it comes to subject to deals and seller financing, I give them the position.
You present the information to them, and then they decide if they want to do that.
It has to be that way.
You can't force them to do that.
Yeah. You'd be dealing with
if you try to force somebody to do it, they're going to be, like you said in the very top, your life's going to be living hell, because they're going to constantly be wanting to know what's going on and when you're going to be paying this thing off and what are the updates. And yeah, it's better to just say, here's how this works. This is an option. We can pay you more if you like these terms versus our cash offer, but just know that, this isn't going to necessarily be something that's going to just happen in 30 days, 60 days. Like, I may keep this loan for 20 years.
Yep.
Right. So just, be transparent, and I love it. Don't try to sell them into this. Just give them the information. If it works for them and it also works for you, then it could be an amazing approach. Yeah.
In fact, a lot of times, Dave, what we'll do is we give them assignments. We bring them in, make them a part of the team. That's just awesome. I mean, you have to. And once they're involved with it, you have a much easier transaction.
I always try to make a seller a partner in some way, shape, or form when I'm doing creative things. Then keep them in the dark. There's, it's just going to create more problems. Like, just let them know exactly what's going on. I even tell them too, like, I plan on, fixing this up and selling it and making a profit.
Yep.
Like, I hide it. Tell them.
Yep.
Because then they're not going to come out of left field and be like, well, what the hell? You made a profit. I told you day one that I'm here to make a profit, and I'm going to help you out of a bind. Again, that's where the motivation from these motivated sellers can really make this, make or break this. So I love it. How to make your life super simple. Let's talk about some of these.
Speak the truth. Always be truthful, 100% truthful, 100% transparent. Big one is understanding this process. That is the, if you're going to start doing creative deals, you're going to have, admittedly, it can get complicated if you let it.
Yep.
But if you understand this process, at least on the surface, this is going to help you in the long run. You'll be able to explain things in a calm way, and you're not going to be fumbling, searching for answers and responses to give to your seller. So understand the process. Be transparent here. When the question comes, does my name stay on the loan? 100%. Your name stays on the loan. But you can kind of counter that with the benefits of selling subject to, with things like, you're helping to build their credit, you're helping them to avoid foreclosure, you can get speed of close, you have speed of closing. I've closed these deals in 24 hours. So
that's awesome.
Can be done. And debt relief.
I've never done a deal that quick, man. That's cool that you can do them that quick.
Well, it's a matter of, it was a matter of it was going to auction. It had to be done
right away,
super quick. Yeah.
Right.
And so we closed it ourselves. We didn't use a title company, title policy. We just took the chance. We weren't out anything.
Sure.
So
but you can utilize speed. That's the advantage.
That's right.
I love it.
That's right. One of my favorite things I like to get my sellers on board with me. I like to say this phrase, that this is going to be a tough battle, but there's going to be a great reward at the end for you. I promise. So, and then again, invite them to help with the process, make them a part. bring them onto your team.
Yep. And I love that, man. That's amazing. Yep. All right, let's talk about liens.
Real quick. So on liens, now everyone's seen these municipal liens, they've seen federal liens, federal tax liens, all of this stuff. And particularly when it comes to federal tax liens, people tend to run away from those. People tend to go, oh, Jesus.
I've made a lot of money on tax liens in the past because we can negotiate them down. And people don't know that. And we can get them under contract, negotiate the lien down to 20 or 30% of what's owed. And all of a sudden we had a deal that was a little bit of a deal become a massive deal. I love liens.
So I'll tell you what, since you bring that up, I dealt with Medicare one time.
Yeah, and, absolutely. You can sometimes even get it to go all the way away. Sometimes.
And we negotiated this one down. It was a surprise lien. Like for some reason it wasn't discovered on the buy side. Mm-hmm. And in the meantime, because there's something called a 5-year look back period with when you're dealing with Medicare. So they will look back at the transactions of the
recipient of the Medicare
recipient. Yeah. Thank you. Mm-hmm. They'll look back 5 years, and if they have a large transaction in the last 5 years, they can absolutely attach a lien to that property. That's exactly what happened to us.
So it came later.
It was an $80,000 lien. When we went to go sell it, we had it under contract to sell, rehab it.
An extra 80. That's a big chunk. Whoa.
Yeah. We were going to have to come to the table, I think, with something like 45 or something like that. So
just to sell it.
Just to sell it. Ooh. Yep. So we called them up. We negotiated that $80,000 lien down to $8,000.
That's 10%.
Yep. Yeah.
I love it.
Other than what they call super liens, which are your municipal, some of your
sewer bills, basically, right?
Sewer bills, basically, yeah. Anything super lien, like a tax deficiency or anything like that. All of those are negotiable. All of them.
And so even the sewer bills I've found to be negotiable. Now, you're typically not going to get them 10%, but I've gotten them down to half before.
Man, I have never been that fortunate ever.
Yeah, we've gotten them. Now it's not as easy. I'm not going to sit here and act like that you can do this in your sleep, but there is a little wiggle room on those sometimes. Yeah.
So I would say when we talk about, I'm going to go back to the beginning. When we talk about buying properties subject to, we're not just talking about subject to financing. We're talking about subject to any and all existing liens or some of the existing liens.
Got it.
It's all got to work out in the numbers. If I've got a $20,000, I don't know that this would happen, a $20,000 sewer lien, and if I can pay that, if I can buy that property subject to that lien and then negotiate that down later, then hey, I'm totally happy with that. I'm totally, and your seller doesn't necessarily have to know that you have that ability. That's what you get paid for, right? You get paid for this knowledge. You get paid for solving this problem. And so we love running towards liens. It's one of the, one other thing about liens. I'll say this, a lien is not something, it's one of those lists that you can build that doesn't have a super high turnover rate. It takes a while to build up those liens. So it just wears on people over time. And so if you're looking for a distressed seller, look for someone with, we start out with $600 sewer district liens. That seems to be the cutoff. When the sewer district files a lien, $600. Well, why hasn't somebody paid a measly $600 to bring that current?
There's some reason
something's going on.
Something's going on.
Absolutely love those. And we will absolutely take those on. We have no problem doing that.
Man, I love it. This is so awesome. All right, guys, look it up. Jeff's got all kinds of awesome stuff here. I'm going to link all this stuff, Jeff. So I'll either pull them from the slides, and I got the text as well too, or I can have you send me some of this stuff, but connect with Jeff. Jeff's got an awesome group. It's called Sub2 Empire. And he has a coaching program and mentors people. It sounds like nationwide.
Yeah.
On how to do this as well. And, today's training is really just a high level, like what it is, how it works. And each area, each state's going to be a little different, but at the end of the day, the process is the same, right? We're helping sellers that are motivated get out of a property. We're also being able to, offer creative solutions to get into properties with little to none of our own money. And it's truly a win-win if the scenario is right. Now, there's some reasons or some places and some, not so much places, but some scenarios, I should say, where it may not be right. And we kind of talked about those in this call and earlier in the video. They're, if they're mentioning attorneys or, they have, no interest in being partnered with you on this deal for long term, then this might not be a solution to them. Right. But there's a lot of opportunity out there when the seller is motivated and you can truly help them. This isn't necessarily just helping ourselves get into real estate deals. That's a big part of it. Let's be honest. Right. We're here to make money, but we're also going to be able to help people by using this strategy and save their credit. Right. And maybe even, make money for them. And depending on how we structure the deal, make money for them, make more money for them in some cases than they would normally get with, the traditional brokerage agents, or even dealing with an investor / wholesaler that comes in with that lower cash offer. So this is awesome. Jeff, this is so great. Thank you so much for everything and for being here and in breaking some of this stuff down and explaining it. Now, again, this is a high level explanation. We could talk about this for, days and get into the nitty gritty of it. But I just really am happy to, just kind of give everybody the overview of what it is, how it works. And I love that you also brought into the picture here the pros and cons, because if you neglect the cons, and that's the thing, a lot of people, they're going to teach and they're going to say, oh, here's all the pros, but they leave those cons out. It's like, man, you're setting people up for failure. But we're laying it all out. Here's the perfect situation, and here's also situations that we don't recommend you do this with. Here's the pros, but also here's some of the cons, and here's how to make your life awesome using this strategy, and here's how to make your life hell using this strategy. So don't do these perfect things. So all of that is awesome. Amazing. Thank you, Jeff. You're the man.
You. Yeah, man. A couple of parting words, I guess. I'll tell you this. If it weren't for that little hiccup, where I followed David Dodge, tried to keep up with the Joneses. I'll tell you, if you're not looking at creative structures or creative strategies right now,
you're leaving a lot of deals on the table.
Yeah, either your head's in the sand and you really are. There's just so much opportunity out there, and don't be afraid. Don't be afraid to start bringing these conversations up to your sellers. Start talking to these people about this. I'm telling you, people are way more open to this than you would ever imagine. I cannot believe. That's almost exclusively what I deal with now is creative deals. There is some, some cash deals that I do, but 90% of everything I do is 100% creative, whether that's subject to or some form of seller financing, seller carry, something like that. But don't be afraid to get out there and start having these conversations, man. I'm telling you, the opportunities are there, and you can make a lot of money at it for sure.
Absolutely. Jeff, you are the man. Such an awesome guy, awesome investor, always a giver. I can't thank you enough. I owe you a steak dinner. You don't owe me shit.
I owe you a steak. You can buy me one.
I owe you a steak dinner and some beers. But this is awesome. I love it. Thank you so much, guys. The recording will be in Skool. I'm going to link to some resources as well as how to connect with Jeff. And if you want somebody that is a pro and I can walk you through these things and even partner with you on deals, Jeff does all these things, through his own community. So we'll definitely link there. And again, Jeff, you're the man, dude. Thank you so much. Let's open it up for a quick Q&A, but I want to respect Jeff's time. So if we have any questions, let's rock. And you know what I'm going to do though? I'm going to end the recording so we're not going too long. And we'll just do the Q&A for the live folks. And again, if you guys are here watching the replay of this, down below this video, there's going to be a ton of resources when I get it added in here, and looking forward to, to helping you guys start doing more creative deals. That's the goal. That's the point. All right. We're going to sign off on the recording, but we'll stick around for the live Q&A. And that's what you get if you come to these live calls. You get these Q&As. All right. Signing off.
Household easy, we close fast and anytime that works for you. Your house don't need it, we'll throw cash, it hits so fast, don't know what to do. Wanted to care to keep it, no declutter.